Lesson 3: Margin and Leverage in Futures Trading. Welcome back to Mastering Futures and Options Trading, a comprehensive course. In this lesson, we'll be discussing two fundamental concepts in futures trading: margin and leverage. These concepts are crucial for understanding how futures trading works, as they allow traders to control large positions with relatively small amounts of capital. By the end of this lesson, you'll understand how margin and leverage work, their benefits, and the risks involved. So let's get started. First off, let's talk about margin. Margin is a term you'll hear often in the world of trading, so it's essential to grasp its meaning fully. In the fast-paced world of futures trading, two terms that are crucial to understand are margin and leverage. These concepts play a significant role in determining the potential risks and rewards of trading in the financial markets. So let's take a closer look at what margin is all about. Margin refers to the initial deposit made by traders to cover potential losses on their positions. In simple terms, it's a form of collateral that allows traders to control larger positions with a fraction of the total value. For example, if a trader wants to buy a futures contract worth 1 lakh rupees with a margin requirement of 10%, they would only need to deposit 10,000 rupees. Now let's break down the two main types of margins you need to be familiar with: initial margin and maintenance margin. Initial margin: this is the amount required to open a futures position. It is usually a percentage of the total value of the contract. For example, if you want to buy a futures contract worth 10 lakhs rupees and the initial margin requirement is 10%, you need to deposit 1 lakh rupees. Maintenance margin: this is the minimum amount that must be maintained in your account to keep your position open. If your account balance falls below this level due to market fluctuations, you'll receive a margin call from your broker to deposit additional funds. Let's pause here and consider an example to make this clearer. Example: understanding margin with a gold futures contract. Now, let's imagine you've decided to buy a gold futures contract. The total value of the contract is 5 lakhs rupees and the initial margin requirement is 10%, so you deposit 50,000 rupees. However, if the market moves against you and your account balance drops below the maintenance margin level, your broker will issue a margin call. In this situation, you'll need to deposit more funds to maintain your position. Now, let's move on to an equally important concept in futures trading: leverage. Ready? Let's explore this together. Leverage, on the other hand, amplifies the potential profit and losses of a trade by allowing traders to control larger positions with a relatively small amount of capital. In the above example, the trader's leverage would be 10x, 5 lakh rupees contract with 50,000 rupees margin. This can significantly boost profits, but also increase the risk of substantial losses. The amount of leverage you have depends on the margin requirement set by your broker. For example, if the margin requirement is 10%, you have a leverage ratio of 10:1. This means you can control a position worth 10 lakhs rupees with just 1 lakhs rupees. While this can significantly increase your potential returns, it also means that even small market movements can lead to substantial losses. Let's consider a practical example to see leverage in action. You buy a futures contract for crude oil with a total value of 10 lakhs rupees and the margin requirement is 5%. You deposit 50,000 rupees as margin, giving you a leverage ratio of 20:1. If the price of crude oil increases by 5%, your position's value rises to 10 lakhs 50,000 rupees and you've made a profit of 50,000 rupees, doubling your initial margin. However, if the price drops by 5%, your position's value falls to 9 lakhs 50,000 rupees, resulting in a loss of 50,000 rupees, which is your entire initial margin. Let's walk through a nifty future contract to understand how margin and leverage work in practice. Imagine you're trading Nifty 50 futures. The current index level is 24,000. and each contract represents 25 units of the index, making the total contract value 6 lakh rupees, 24,000 into 25. With an initial margin requirement of 10%, you need to deposit 60,000 rupees, 10% of 6 lakh rupees, to open the position. Now let's see how leverage can amplify both gains and losses. If the Nifty 50 index rises to 24,300, your position's value increases to 6,07,500 rupees, 24,300 into 25. Your profit would be 7,500 rupees, calculated as 24,300 minus 24,000 into 25. With an initial margin of 60,000 rupees, you've achieved a 12.5% return on your margin. 7,500 rupees divided by 60,000 rupees. On the other hand, if the index drops to 23,700, your position's value decreases to 5,92,500 rupees, 23,700 into 25. In this case, you would incur a loss of 7,500 rupees, calculated as 24,000 minus 23,700 into 25. This results in a 12.5% loss on your margin. This example demonstrates how leverage can amplify both gains and losses in trading Nifty 50 futures with a 10% initial margin requirement. It emphasizes the importance of managing leverage effectively to mitigate risks and make informed trading decisions. Here is the example presented in a tabular format for easy reference. This table illustrates how leverage can amplify both gains and losses when trading Nifty 50 futures. It shows the impact of index movements on the position, value, profit, loss, and return on margin. Leverage can magnify both profits and losses, emphasizing the importance of managing risk and leverage effectively in trading. Using margin and leverage in futures trading offers several benefits. Increased buying power. Leverage allows you to control larger positions with less capital, increasing your potential returns. Capital efficiency. Trading on margin frees up capital that can be used for other investments or trades, making your trading more efficient. Diversification. With more capital available, you can diversify your trades across different assets, reducing overall risk. For example, if you have 1 lakh rupees and the margin requirement is 10%, you can control positions worth 10 lakh rupees. This allows you to spread your capital across multiple futures contracts, such as Nifty 50, gold, and crude oil, reducing your exposure to any single market. While margin and leverage offer significant advantages, they also come with substantial risks. 1. Amplified losses. Just as leverage can amplify gains, it can also amplify losses. Small adverse market movements can result in significant losses, potentially exceeding your initial margin deposit. 2. Margin calls. If your account balance falls below the maintenance margin level, you'll receive a margin call from your broker to deposit additional funds. Failure to meet a margin call can result in the liquidation of your position at a loss. 3. Market volatility. Futures markets can be highly volatile, and sudden price movements can lead to large losses. It's essential to monitor your positions closely and be prepared for market fluctuations. For example, if you're trading a futures contract with a leverage ratio of 10:1 and the market moves against you by 10%, your entire initial margin can be wiped out. If you're unable to meet a margin call, your broker may liquidate your position, resulting in further losses. To mitigate the risks associated with margin and leverage, it's crucial to implement effective risk management strategies. 1. Use stop-loss orders. Setting stop-loss orders helps limit your losses by automatically closing your position if the market moves against you beyond a certain point. 2. Diversify your trades. Spread your capital across different assets to reduce your exposure to any single market. 3. Monitor your positions. Regularly review your positions and account balance to ensure you can meet potential margin calls. 4. Avoid over-leveraging. Use leverage judiciously and avoid taking on more risk than you can handle. For example, if you're trading multiple futures contracts, set stop-loss orders at strategic levels to protect your capital. Diversify your trades across different markets, such as equity indices, commodities, and currencies, to spread your risk. Regularly review your positions and ensure you have sufficient funds to meet potential margin calls. In this lesson, we've covered the essential concepts of margin and leverage in futures trading. We discussed how margin works, the benefits and risks of leverage, and effective risk management strategies. Understanding these concepts is crucial for successful futures trading. In our next lesson, we will delve into the intricacies of the futures market structure. We will explore various aspects and gain a deeper understanding of how the futures market operates. Thank you for joining us today, and stay tuned for an insightful journey ahead. See you in the next lesson.